your pension is not safe. If it wasn't for the Bank of England taking emergency actions, you could have already lost your retirement funds. You heard me correctly. The Bank of England confirmed that a large majority of pension funds in the UK were on the brink of collapse in 2022 during the UK market turmoil in September. If they had intervened just in time, your pension could have gone to zero. But wait, we're not out of the woods yet. Because what if incompetent, large pension funds could be still mismanaging your money and central banks don't have the capability to save your pension fund from collapse next time when abnormal market volatility arrives again? If that's not enough to make you break in a cold sweat, I have some even more shocking news for you. Even without volatility, your pension pot could still go to zero.
What?
It's gone. It's all gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
Traditional pension plans are facing many unprecedented challenges due to mounting economic pressures and a rapidly aging population. Imagine a ticking time bomb with your retirement funds wrapped inside it. Not only that, in other countries, private pensions have been subject to mismanagement and corruption. For example, in a 2019 report, the Indian government found that over 31 million people were defrauded of their pension savings in the last 10 years. But don't panic just yet. In this video, we'll explore the root causes of the upcoming pension crisis and the potential impact on your retirement, and most importantly, what you can do to protect your future. So, make sure to watch from start to finish to get all the vital information you need to know what to do next. Because the last thing you want to do is get caught off guard when it comes to your hard-earned retirement funds. What was the pension crisis and why did it happen? In September 2022, the UK bond market experienced significant turmoil following the government's announcement of a controversial tax cut plan. This led to a sell-off of government bonds by investors, putting pressure on thousands of corporate pension plans to raise cash to meet urgent calls for liability-driven investment strategies known as LDIs. LDIs is an investment strategy used by pension funds to align their assets with long-term liabilities. It's meant to minimize the mismatch between assets and future liabilities by investing in assets that generate cash flows correlated with future pension payments, reducing risk of funding shortfalls due to market volatility interest rate changes. The sharp increase in gilt yields that followed the government's bungled mini-budget caused the British pound to tumble to record lows against the dollar.
The British pound touches a record low against the dollar.
The government has just committed to borrowing a lot more money,
resulting of a potential loss of around £500 billion, or approximately 28% of the value of the retirement schemes managed by pension funds. This isn't just a paper loss, as pension funds had to sell assets to meet their collateral calls. The impact of UK pensions is therefore significant and concerning. In case you don't know what the bond market is, it's like a big store where people can buy and sell something called bonds. A bond is like an IOU note. Imagine your friend needs to borrow some money from you, but they can't pay it back right away. So they write a note saying, I owe you $10 and I promise to give it back to you in a year. That note is like a bond. In the same way, when a company or government needs to borrow some money, they can issue bonds. People can then buy these bonds, and in exchange for lending them money, they receive a promise that they get paid back with interest for a certain amount of time. Government gilts are a type of bond that is issued by a government, like the UK government. They work in the same way as other bonds, but because they are issued by a government, they are considered very safe investments. So, just like you might lend money to a friend and get paid back with interest, people can lend money to a government through buying government gilts and get paid back with interest. The recent sell-off in the UK bond market didn't just affect bondholders, it sent shockwaves through the whole financial system, putting stability of the UK economy at risk. Pension funds were forced to sell off their bonds, causing a feedback loop like a never-ending game of dominoes that threatened to send us hurling towards another financial crisis like 2008. But wait, who's coming in to save the day? It's none other than the Bank of England, swooping in with an emergency £65 billion bond buying program to calm the markets to prevent a catastrophe. Phew! Crisis averted. Or is it? It turns out the effect of the crisis has spilled over into other markets. Insurance, investment funds, and pension funds are all facing financial strain. And without proper regulation, we could be looking at more bailouts and inventions in the future. So, what does this mean for you and your retirement funds? It's a wake-up call to pay attention to the risk of pension funds mismanaging our money. We need to be vigilant and ensure that our hard-earned savings are protected so that we are not caught off guard when the financial storm hits. What problems do pension funds face in the future? The recent mini-budget crisis we dodged may have seemed like a one-off event that we were fortunate enough to escape. But even if we don't have another crisis ever again, what if I told you your pension is still at risk of going to zero?
Hey yo, what the f?
That's right, we're talking about a ticking time bomb that could go off at any moment, leaving retirees potentially with no retirement. The mini-budget crisis we narrowly escaped was just the tip of the iceberg. The truth is, pension funds all over the world are facing significant challenges that could spell disaster for retirees. We have already seen the collapse of several high-profile pension funds, including UK's BHS and Carlyle, have left pension workers facing reduced pensions or no pensions at all. It's just a matter of time until we see more pension funds capitulate. But don't just take my word for it. Let's look at the facts. Firstly, we have the demographic time bomb ticking away in the background. Birth rates are declining while the population is aging, leading to a significant shortage of workers contributing to their pension funds. It's like trying to fill a bathtub with a small cup while everybody else is draining it with the big buckets. The end result? Pension funds are emptying faster than filling up, resulting in lower investment returns and greater risk of funding shortfalls, leaving retirees in a state of constant uncertainty and worry. In the UK, research by Royal London has said that the average worker needs to save at least £3,000 per year to make up for the shortfall in their pension fund. But that's not all. The lack of transparency and high costs associated with pension funds only adds to the uncertainty and risk. And in changing to government regulations and tax policies, you've got a recipe for disaster. Another wrong move by the government could see pension funds tumbling. But wait, there's more. The lack of transparency and high costs associated with pension funds make the situation even worse. It's like trying to navigate a maze blindfolded. You never know what's around the corner. And if that wasn't enough, changes in government regulations and tax policies only add to the chaos. It's like trying to balance a teetering stack of dishes while somebody else throws more dishes at you. And let's not forget about the risk of management, corruption, funding constraints, poor data management, and balancing the interest of stakeholders. These factors have already led to financial difficulties for pension systems in the past, putting retirees at risk of losing their pension funds or receiving reduced benefits. It's a terrifying thought, but a reality that we all need to be aware of. Finally, let's talk about the complexity of pension plan terms and conditions. If you're like most people, the technical jargon and confusing terms makes your head spin. This makes it incredibly challenging for us to make informed decisions on what's best for our retirement plans. Let's talk about some of the key risks you need to keep in mind. First up, we have market risk. Because let's face it, the market can be unpredictable like a drunk uncle at a family reunion, and their fluctuations can wreak havoc on your pension fund. Economic conditions, politics, and other factors could cause market volatility, which can impact the value of your potential fund's assets and the ability to pay out retirement benefits. Next, we have interest rate risk. Imagine you're playing a game of Jenga, but instead of just trying to keep the tower from falling, you also try to keep pension funds from collapsing. Interest rates rising is the villain in the game, always lurking in the shadows, waiting to strike. If interest rates go up, the value of bonds held by your pension fund usually go down in value, and your retirement can take a hit. But if you raise interest rates quickly in a short period of time, it's like you accidentally pull out the wrong block sharply in Jenga. Everything comes tumbling down, and it's game over. Then we have inflation risk, which can erode the value of your pension benefits over time. Inflation is like that annoying kid who keeps taking your toys away, leaving you with less and less. Pension funds may invest in assets that can provide protection against inflation, but there's no guarantee that these investments will keep pace with inflation. Credit risk is another factor to keep in mind, as pension funds tend to invest in bonds or other debt securities issued by companies or governments. There is always a risk of default or credit downgrades, which can impact the value of your pension fund's assets. And last but not least, we have liquidity risk. Pension funds need to have enough cash in other liquid assets to meet pension fund obligations. If they don't, they may have to sell assets at a loss, which can impact your retirement benefits. What happens if my pension fund goes bust? Retirement is supposed to be the time when you can relax and enjoy the fruits of your labour, right? But what happens if your pension fund goes bust? Let me explore some possible scenarios. First up, your pension payments may be reduced, leaving you with less money to spend on your golden years.
Actually, that's a big problem, Guy. It's a massive problem.
That's a big problem, especially if you're counting on that money to cover your expenses. Next, your pension benefits may be transferred to another fund.
Don't get too excited, this is your game.
The transfer benefits may come with lower returns or reduced benefits, so it's not exactly a win-win situation. If things get really bad, your pension fund may be liquidated, meaning assets are sold off to pay the creditors. As a result, you could receive a reduced payout, and the funds may not be able to provide the full amount of promised benefits. And finally, a pension fund in financial trouble may be restructured or merged with another fund, which could still result in reduced pension benefits or higher costs for you. So, what's the key takeaways here? It's important to choose your pension fund carefully and stay informed about its financial health. Retirement should be a time of relaxation and not worry. Now, you might be thinking, I still want a pension, so how do I choose the right pension for me? Here's some tips to help you make the right choice and avoid a nightmare retirement. First, determine your retirement goals. Do you want to sip pina coladas on the beach or hike mountains in your golden years? Knowing your retirement goals will help you choose the pension plan that meets your needs. Next, Do your research. Look at different pension plans, including defined benefit plans, defined contribution plans, and individual retirement accounts. Check out the fees, investment options, and the features of each plan. Don't forget to check out the investment options by the pension plan. Make sure that they align with your risk tolerance and retirement goals. Consider the fees and performance of each investment option. Speaking of fees, make sure you check the plan's fees. Administrative fees, investment fees, and other charges can eat into your retirement savings. So make sure you understand the total cost of the plan and how it impacts your retirement savings. Consider the flexibility of your pension plan. Can you change your contributions, investment options, and retirement dates? Make sure the plan aligns with your changing needs over time. Also, check out the plan's financial stability. Do you want to end up in a pension plan that is on the brink of collapse? Look at the plan's performance over time and make sure that it has adequate assets to meet its obligations. Finally, consider getting professional advice. A financial advisor or retirement planner can help you make informed decisions about your pension plan and avoid any nasty surprises in retirement. However, don't just choose any financial advisor. Look for someone who shares the same ideas and plans as you. Otherwise, they can lead you down the wrong path with everyone else. So, don't leave your retirement to chance. Choose the right pension plan and live your retirement dream. So, let's talk about how you know if your pension fund is safe.
I've got no pension and I've still got the bedroom tax.
When looking at pension funds, it's important to consider the fund's financial stability and security. Here are some factors to consider to help determine if a pension fund is safe. First up, check out the pension fund's performance. Has it consistently generated profitable returns, or has it been underwhelming like a 2-star movie? A pension with a great track record is a good sign that it's financially stable. Next, take a look at the fund's investment strategy and asset allocation. Is it diversified with a mixture of different asset classes? A well-diversified pension fund is like a well-balanced diet. It's generally considered healthier and less risky. You will also want to review the fund's financial statements. Are they adequately funded and has sufficient assets to meet their personal obligations? The fund's financial statements should also provide information of their investment holdings and fees. Check out for regulatory oversight. Is the pension fund regulated by a government agency or industry body? Regulators can provide oversight and ensure that the fund is following industry standards and regulations. And last but not least, consider the fund's reputation and the companies that manage it. Look for reviews and ratings from independent sources and check out if there have been any legal or regulatory issues in the past. Remember, it's important to do your due diligence before and after choosing a pension fund. By considering these factors, you can ensure that the pension fund you choose is safe and can provide you with the retirement you need. If you're like me and don't have trust in pension funds or the schemes itself,
fear not, brother.
Fear not. There are several alternative passive investment options available that are simple and easy. The good news is you don't need to be an investment guru to get started with these options. Let's start with wealth managers. Imagine having your own team of investment experts who handle all the complicated stuff for you. They'll develop a customized investment strategy that meets your needs and risk tolerance. With the right wealth manager, your investments will be in good hands while you sit back and relax. And while it may only offer moderate returns, it is an easy way to dip your toes into the passive investment waters. If you're feeling a lot more adventurous, then why not try index funds? This moderately passive strategy involves investing a fixed amount of money at regular intervals. It's a diversified portfolio that tracks the stock market's performance, has lower fees, and can provide attractive return over the long term. For those who like shiny things, investing in gold and silver can be a moderately passive and less risky option. Physical precious metals are seen as safe haven assets and can provide protection against inflation and economic instability. But remember, investing in these assets do still carry some level of risk, and it's essential to do your research and seek professional advice before investing. Real estate investment trusts, as known as REITs, are another exciting option that can provide a passive and less risky way to invest in the property market. Imagine owning and managing real estate properties without any of the hassle. While it may only offer moderate returns, it is a great way to diversify your investment portfolio. Lastly, high interest savings accounts are a low risk and very passive option that offers a safe and secure way to grow your savings over time. While the returns may not be as high as other investment options, it is a great way to start putting your money to work whilst waiting for other investment opportunities. There are plenty of exciting and accessible passive investment options available to you. However, it's important to remember that past performance isn't a guarantee of future returns. As with any investment, it is essential to consider your investment objectives and risk tolerance before committing your funds. Each option comes with its own unique risks and benefits, making it crucial to do your research and seek professional advice before making any investment decisions. So take your time, weigh your options, and invest wisely. If you found this video helpful, please give it a like and subscribe to the channel if you want to make sure that your retirement is safe. And if you haven't done so already, please check out my short form videos to consume great information within 60 seconds.